Hi, everyone. Thank you for joining us. We're just going to give people 1 minute to join and we'll get started. All right, we're going to get started. Thank you so much to everyone for joining us today for our Q2 Market Perspectives webinar. My name is Julia Davidoff. I'm a marketing associate here at New Frontier Advisors, and I am very pleased to be joined by our CIO, Robert Michaud, and our research analysts, Joy Zheng and John McCrary. All right, so our agenda for today, we're going to start off with Robert for an overview of our investment process, followed by Joy giving us a performance review, and lastly, we will go to John for our market perspectives discussion. And we'll finish up with some brief marketing updates and an interactive Q&A session. If you have questions throughout the presentation, we encourage you to please submit them through the Q&A feature of GoToWebinar. And with that, I will hand it over to Robert.
All right, thanks, Julia. So investment process. Investment process may be a little bit of a mischaracterization of exactly what I'd like to talk about today. Historically, I have talked a lot about our investment process, and I do, of course, love talking about our investment process, optimization, and all these things that we, I think, are hopefully rightfully proud of, the consistency, the track record, all the research and technology that has gone into it. But today I'm going to talk a little bit more about the big picture portfolio updates, what's going on in markets and performance, and thinking about how we should be positioning ourselves going forward. Of course, all in the context of our investment process, given that we're not trying to predict the future, we are not trying to make big bets. There's the overview. And but first, I think it's important to start with maybe a note of thanks. So we passed 5 billion in assets for the first time as of the end of this quarter, and it has been a steady climb since 2004. It's been personally rewarding, and one of the things that I've appreciated the most and been most proud of over the last 16, 17 years is talking to advisors and having them come up to me and say that we've never disappointed them. And I think back and what's made it possible to have been investing for so long and done pretty well over a number of challenging market environments is that we have this consistent investment process that, of course, we've modernized a great deal, but it's based on a optimization framework and world-class technology and research about how to build a diversified portfolio that's optimized over an uncertain future. And whether it's a pandemic or a financial crisis, and it's done consistently well. Oopsie. So, being able to not panic in 2008 or 2020, being able to take the best ideas from the institutional world and academia and have best practices of taking the things that big institutions do well in terms of being able to invest in global growth and avoid some of the common mistakes of the industry, and use it all in our framework has, I think, worked pretty well. So thanks, and we'll keep trying. That's what we do. So asset allocation changes. There actually were no model rebalances this quarter. Certainly doesn't mean that we didn't do anything. And actually, it's been kind of an unusual quarter. It's been, we're looking back and trying to figure out when was the last quarter that we actually didn't rebalance. You know, some people think of us as a core strategic manager, which means that maybe we don't have to be working all the time, but of course we are working all the time, and we did relatively recently rebalance all of our models in January, February, and March. But this quarter there were no rebalancing changes, no model updates. And why that is that there was in some ways a somewhat surprising quarter from the end of where we were, 3 months ago. There was a reversal of some asset class movements. Everybody was expecting interest rates to go up, but things weren't as dramatic as they had been. And actually, it was a fantastic quarter for most asset classes, and pretty much every asset class we invest in went up either moderately or strongly. So Joy will of course talk about that, but stock bond ratios didn't change too much. Then basically the thing that we pay the most attention to, which is the portfolio that our clients are invested in, is this still the right portfolio for their investment objectives with the right risk characteristics? And so it was. And this is a thing that we continue to check on a daily basis. So what's going on right now? It turns out that in some ways a lot, in other ways not too much. So volatility is relatively low. In spite of, I just wanted to point out sort of the two most interesting volatility measures is the volatility of stocks and the volatility of bonds. Maybe the best measure of the volatility of bonds is the MOVE index for treasuries. And so that's below its historical average, and the VIX is also, in sort of historical lowish, not bad kind of range. And that doesn't quite fit with a lot of people's concerns because valuations are quite high. If you look at any measure, PE, PB, they are historically high for the US, very high for growth. Thankfully, as you can see on this chart, not as bad as during the dot-com days, but still high valuations. And this has been because we're emerging from a pandemic, and the US is seen as one of the more stable places for investors. But high valuations do always give people some sort of concerns. And the problem is, to stick on valuations for a moment, other international markets are also higher valuation than they had been historically, although perhaps not quite so much as the US. And that should make you wonder, why? So inflation and economic growth are certainly things that people are concerned about. People are concerned about, in some sense, too much economic growth leading to inflation. From most investors' perspectives, the prospect of long-term economic growth is a great one, right? The thing we should be worried about is the economy not doing well, not the economy doing too well. And if the economy does too well, there will be some short-term disruptions, but it's ultimately going to be good for investors if the economy is doing well. And I think another thing to keep in mind with inflation and all the statistics that you see right now is that people are the media loves to show sort of startling numbers because that's what news is. And a lot of the year-over-year numbers think about where we were a year ago. And so you are going to see startling numbers for a while now until the pandemic has been over for more than a year. So think about the other thing with valuations are rates are low. So rates are low means fixed income asset prices are high. Corporate spreads are low. And so we're in the situation where everything is expensive. And so what's an investor to do? Even real estate, as people like to talk about, is quite expensive. So really everything that a typical household will own is going to be expensive right now. And that doesn't mean that everybody should get out of the market, but that means that people should pay attention to their portfolio and make sure that they do have the right exposures. So going forward, just to keep it simple, we do fall back on our investment philosophy of taking the best practices of the institutional world, and that does mean you don't want to be timing the markets. And so even when things feel like they might be expensive, if you look over history, there's lots of times where in hindsight things seem like you should do things one way, but that turns out to not be the case right now. And being in the market now, every study has shown, is better than worrying about it and waiting for the perfect time to be invested in the market. And so you can talk to us if you want a more specific example of that. But the other things that are sort of non-solutions as well as trying to stay out of the market is, you've heard a lot of talk about, well, maybe now's the time for active management. If you just pick the right stocks, you just pick the right asset class, or maybe time certain other things, then active management is going to do well. But active management has never been the right answer. There has never been a time, no matter how good it seemed like the environment for active management is likely to be, where active managers actually have, as a group, outperformed the broad market. And just one more little tidbit of people thinking about, well, the next half of the year it's not particularly based on the first half of the year. So if you hear anybody say that, well, markets are always positive for the year when the first half is good, that's not a particularly informative thing. Markets do, on average, go up. It is good to have a broad exposure to asset classes. It's good but most important, you want to make sure that your investors are in the right right portfolio for their investment objective. So I'm going to let Joy talk now, and then I will hopefully answer lots of questions later. Thanks.
Thanks, Robert, and thank you for giving us the big picture here. And I'm Joy Zheng. I'm New Frontier research analyst. So in the next 10 minutes, I will go over the Q2 performance of New Frontier portfolios, including global core, tax-sensitive, and multi-asset income. Then I will cover asset class performance. In the end, I'll briefly mention New Frontier index performance. So let's start. First, we have New Frontier Global Core. What we have here in the chart is net portfolio performance along with the benchmark for this quarter and year to date. As we know, stock markets reached new highs in the second quarter, so as New Frontier portfolios. All profiles continue to post strong returns this quarter, ranging from 2.2% to 6.6%, showing the darker blue bar in the chart. The biggest outperformance, up to more than 1%, came from 40-60, followed by 60-40 and 20-80. They benefit most from long duration exposure on the back of falling yield. Exposure to US REITs and countries like Switzerland and Canada also helped. On the other hand, the aggressive risk profile slightly underperformed this quarter, as the excess returns by those drivers, as I mentioned, were offset by the relative underperformance of more aggressive assets, including US small caps and emerging countries like China. However, if you look at year-to-date performance, it was the opposite story. The aggressive risk profiles did better than the less aggressive ones, indicated by the green bar in the chart. As we know, fixed income did not do well in Q1, and Q2 was a reversal of Q1. And now moving on to New Frontier tax sensitive. I usually spend less time on this page because we have consistent philosophy and same process for both global core and tax sensitive. And additionally, we have comprehensive considerations for tax management. So in terms of total returns pre-tax, tax-sensitive performed in line with global core. You can see the municipal bonds did well, and high-yield muni was the best performer in the muni category for this quarter. On a year-to-date basis, tax-sensitive actually did slightly better than our global core because munis did well in both Q1 and Q2. So the last one is multi-asset income portfolios. They continue to contribute strong total returns with all profiles outperforming the benchmark this quarter. The outperformance again was helped by long duration exposure and US REITs allocation. And currently, yields for our portfolios are around 3 to 3.3%. That is roughly the twice yield on US Ag and on global equities. And for investors who have the investment objective income on mind, it's naturally to ask about what income means in this inflationary environment. So, and I want to pause here to talk about this fixed income in kind of the volatility and dividend trade-off in our multi-asset income portfolios. One might be concerned about higher inflation levels and want to shy away from bonds because the interest rate might get higher. But this chart shows that dividend yield per unit of volatility for some high-yielding bonds, dividend stocks, and in the end, our multi-asset income portfolios. The right axis measures dividend yield, which is shown in the green dot in the chart. While bonds yields in nominal terms might get less attractive when the inflation gets higher, high-yielding bonds still have very attractive dividend per unit volatility compared to dividend stocks and sectors like utilities and REITs. And so they are still valid investments in the portfolio. And our multi-asset income portfolios are optimized across different bonds and equities with risk return and risk dividend return trade-off in mind. So as a result, they are competitive, not only in total returns, total yields, but also on a risk-adjusted basis. And from this chart, one might think high yield looks a very good deal in terms of yield and volatility. Should we just switch out of our allocation, our bond allocation, and buy into high yield for 60-40, for example? The answer is of course not, and I'm going to touch base on that in the later slides. And let's move on to asset class performance for now. Then first we have fixed income portfolio. Fixed income performance. As we know, bonds partially recovered from the first quarter. Let me switch back. Bonds partially recovered from the first quarter as markets relax a bit from concerns of higher inflation levels. US Ag gained 1.7%, but was still down 1.6% for the year. Yield curve flattened during the quarter. Long duration performed the best in Q2, followed by credit. TIPS were up 3.1% for the quarter. Emerging debt had a strong recovery from the first quarter. A weakened US dollar also helped international treasuries. And by the way, US dollar was up 4% in the first quarter and down 1% in the second quarter. And since late 2020, we have been asking about the duration. Why do you have duration in the portfolio? And as Robert mentioned about our process, we don't time markets. So it's not about that we forecasting that interest rates will go up or go down, but this is for diversification. Q2 is another example that directional bets on interest rates did not reward risk taken. And duration alone might help or hurt performance from this time period to another time period. But how we manage the portfolio is not a one scenario type of thing, but taking into account of thousands of different scenarios and optimizing around long-term risk return trade-off across different asset classes. So duration within fixed income allocation is well balanced with other parts of the portfolio for risk management. When people switch out of duration, say moving to credit, worry about the scenario of rising interest rates, the portfolio is very likely to increase overall risk by overexposing to credit related, like the equity related risks. For example, we can tell from 10-year correlation metrics on the upper right, and also from the chart below, that high yield has very high correlation with S&P about 0.77%. About 0.77, while long treasuries usually move in the opposite directions. So when equity suffers, high yield in the portfolio is not going to provide the diversification you needed when you need it most in this scenario. And moving on to equity section, this was another quarter for strong gains for stock markets. As reopening continued, US continued to outpace the rest of the world, followed by Europe, emerging markets, and Pacific being the last. Despite outperforming the broad market since late 2020, value did not continue this trend this quarter after the markets took in Fed's assurance on controlling inflation expectation. Growth outpaced value, with large cap growth being the best performing asset in Q2. On the year-to-date basis, we can still see small cap was the leading performer with 26% year-to-date performance. And US REITs, as Robert mentioned, continue to have a great quarter, up 11% in Q2 and 21% for the year. Housing prices have been rising and now actually surpassing the pre-pandemic levels. And in the end, let me briefly talk about our index. As I've talked about in the previous webinars, we have global indices and US indices that are constructed in the same investment process as our portfolios. So they reflect our investments in real time. For a 60/40 investor, our 60/40 index, both global and US, can provide a more comprehensive way of looking into what's happening to your 60/40 portfolio during the day. So this is a better way to kind of gauge the daily activities and also look at portfolios and performance in longer term. And we know in Q2, new frontier indices reached new highs. And the table here shows the global US indices performance for this quarter and year to date. And I'm not going to talk about the global index performance as they are very similar to our global investments. But for US index here, again, they have a very strong quarter and a strong year. As US outpaced the rest of the world, US 60/40 gained 5.4% for this quarter and 8.5% for the year. So that is everything for performance. With that, I'm going to pass over to John to talk more about markets.
Thanks, Joy, for the great review of performance. I'm John McCrary, a research analyst at New Frontier. So I'll be discussing some of the key ideas covered in our Q2 quarterly review or commentary. As the global economy continued to reopen, markets reached record highs, with the S&P returning 9% in the second quarter, but inflation soared. Despite the rise in inflation, yields fell significantly for medium and long duration bonds, taking most investors by surprise. The graph on the right shows that although the consumer price index increased, shown in red, 10-year treasury yields actually fell. And correspondingly, value stocks and small caps underperformed, reversing their outperformance in Q1, as Joy pointed out. There were other notable themes this quarter, including global economic divergence, an industrial policy bill, and an agreement on global taxation. But the fall in yields alongside high realized inflation was the biggest story of the quarter. And there were three key causes for the decline in yields. First, investors became more anxious about COVID-19 as the Delta variant spread globally. In the first quarter, investors were very optimistic about the pandemic, but Q2 involved a recognition that yields had risen by too much, too quickly. Second, investors have believed that much of the increase in inflation is likely transitory. Supply bottlenecks and pent-up consumer demand are temporary factors, and another large stimulus bill seemed unlikely. But the most important cause of the decline in yields was the Fed, which reined in inflation expectations. And the Fed's been in a difficult position because both unemployment and realized inflation have been high. This graph shows how the unemployment rate in blue barely changed in Q2, despite the spike in CPI. The Fed has two competing goals: control inflation while also sustaining the recovery by keeping interest rates low and buying bonds. Powell wants to avoid a repeat of the 1970s, when high inflation expectations became self-fulfilling. Instead of raising rates or tapering, his strategy has been to assure investors and the public that the Fed will intervene if inflation stays high. and investors have believed this message, and bond markets indicate long-term inflation levels close to 2%. Nevertheless, if inflation does not soon subside, the Fed's stance will be tested, revealing how much inflation it will tolerate to sustain the recovery. Switching gears, I want to briefly talk about some significant developments in legislation and tax policy. Following a productive first quarter, the Biden administration's only substantial legislative achievement in Q2 was a $250 billion bipartisan industrial policy bill. Aimed at increasing the competitiveness of the US relative to China, the bill provides funding for R&D and advanced technologies, such as microprocessors, which are shown on the right in the graphic. This bill demonstrates that the Biden administration is serious when it talks about becoming more competitive with China. Although the government doesn't always allocate capital efficiently, some prominent economists view the bill as a down payment on innovation that should boost long-term growth. But Biden's other legislative ambitions have faced considerable resistance in the Senate, and negotiations over an infrastructure bill continue. In another policy development, in June, the G7 agreed to a global minimum corporate tax rate of at least 15%. 130 countries now support the proposal. Corporations have long engaged in tax arbitrage, claiming their profits were generated in countries with low corporate tax rates, such as Ireland or Luxembourg. The OECD estimates that tax arbitrage costs governments at least $100 billion annually in tax revenue. The chart here shows the effect of tax arbitrage on corporate tax revenue, or on government tax revenue. Governments with low corporate tax rates have higher tax revenues due to profit shifting, but at the expense of other governments, including Germany and the US, which have higher corporate tax rates. Several tech companies face effective tax rates below 15%, so their stock returns may be slightly lower if the G7 proposal is adopted. But on the other hand, the proposal should be good for investors in the long term if it reduces the amount of resources dedicated to tax arbitrage. Another important theme of the quarter was global economic divergence. While the end of the pandemic is in sight in the US and Europe, many countries, especially developing ones, have limited protection against future waves of COVID-19. This chart shows country vaccination rates by income level. You can see that many high-income countries have administered around 100 vaccine doses per 100 people. You can also see that no low-income country has administered more than 10 doses per 100 people. Since the y-axis is on a log scale, the vaccination gap between rich and poor countries is dramatic. Unequal access to vaccines could dampen the global recovery and facilitate the development of new virus variants. More equal vaccine distribution would promote a less uneven global recovery. To bring everything together, this was another quarter where things didn't work out as expected. It's clear that investors should not be too confident about their forecasts, especially for inflation and yields. Although prospects for the global economy seem strong, economic recoveries involve unpredictable shifts in economic equilibriums, which can cause disruptions, as we've seen with shortages in lumber and semiconductors. And given we don't know what disruptions to expect later this year, an optimally diversified portfolio remains essential. Finally, we have a research update. New Frontier Institute co-sponsored a great presentation this quarter on Bitcoin. MIT professor Antoinette Shore discussed three popular narratives about Bitcoin. She argued, first, Bitcoin is not a suitable vehicle for transactions due to its high transaction costs. Second, Bitcoin is very volatile and therefore not a reliable store of value. And third, Bitcoin is a speculative investment without a stable risk premium. We at New Frontier firmly agree that Bitcoin is not suitable for risk-managed investing because it is a speculative asset. If you want to hear more, Dr. David Esch gives a more thorough summary of Professor Shore's presentation in the final section of the commentary. And to learn more about New Frontier's research and the events we sponsored, you can visit the New Frontier Institute website. And I'll now pass it back to Julia for a few marketing announcements, and then we'll have Q&A.
Great, thanks, John. So while I run through some marketing updates, I encourage everyone to submit any questions through the GoToWebinar Q&A feature, and we will address them as they come in. So first off, we'd just like to remind everyone of the incredible sales team at New Frontier that is at your disposal. And many of you have likely already heard from our newest team member, Kieran Patak, but if you have not, please feel free to reach out to him, and he's looking forward to speaking with all of you. We also want to remind you of Frontier Advisor, which is our one-stop shop for all advisor needs. Here you can find everything from client-friendly materials to our trade announcements, financial goals calculator, proposal engine, performance sheets, and more. And also on Frontier Advisor, you can find relevant blog posts. We selected a few here that we think are relevant right now due to a lot of talk about interest rates. These are actually available through the handouts feature in GoToWebinar, and you can download them directly. If you do not today, you can always visit Frontier Advisor or our main website to take a look at all of the blogs we have to offer. And lastly, we want to remind you that our real-time indices are available to view at any time on our website, on Bloomberg, or on your smartphone. And with that, we will turn it over to the Q&A session. Our first question, if Robert, Joy, and John, you want to come back on screen. All right, great. So we have a question from Jim asking if we anticipate any impact due to any new potential lockdowns that would be caused by the Delta variant or other variants of COVID.
I think I can take that one. In the US, government and health officials have said that we'll likely not experience another lockdown, largely because of the high number of Americans who've been vaccinated. But the situation internationally is less clear for countries with low vaccination rates. A great thing about our investment process, though, is that Michaud optimization takes into account hundreds of possible investment scenarios. Instead of making bets on future events, our process constructs portfolios that account for many different possible investment scenarios, including situations where some equities decline sharply.
Awesome.
Sure. It seems unlikely that the markets are going to ignore the possibility of going back into lockdown. I mean, we're in the office. We just came into the office yesterday, all as a company for the first time, and so this is something that's definitely on everyone's mind. And just as you know, financial economist, when something is on everyone's mind, then you know that it's priced in. And so, and a lot of the, you know, I said the volatility is not too high, but a lot of the market shifts that we have seen recently have been very much due to sort of changes in expectations and concerns about, well, you know, maybe we're not going to fully open quite as quickly as we thought we would. And of course, this is a, you know, complicated market equilibrium of rates, inflation, and all the different asset classes in terms of you know, what it boils down to in terms of future expectations. And so you know, these types of news can affect prices and pretty significantly. But right, as John said, we're doing everything we can to account for this and make sure that we're as insulated from it as it's possible to be.
Great. Thanks, John and Robert. Another question we have from Eric is he'd like to learn a little bit more about if we have any active tax management going on within our tax managed portfolios.
Yeah, sure. So tax sensitive portfolios, they're some of my favorite portfolios because we get to do even more optimization on a taxable portfolio than we do on our what we call our standard qualified portfolios. And so for some people, you know, ETFs are the instruments of choice when you are trying to build a tax sensitive portfolio. So you want to make sure that your taxable clients have the right things for them. So the right type of instruments, ETFs. You need a strategy like ours, which is low enough turnover that you can accumulate gains without turning them all into short-term, highly taxable gains. And then I think our true sort of competitive advantage is our optimization. And so we optimize everything. And in particular, we put a lot of effort into carefully measuring the expected tax consequences of every asset class, every ETF in our portfolios, what the likely turnover is, how much of the total return over time is going to be coming from qualified dividends versus unqualified dividends versus tax-exempt income from municipal bond ETFs, and then optimizing a whole new portfolio to maximize after-tax risk-adjusted wealth, expected wealth accumulation. And so these portfolios look, of course, somewhat similar to our other portfolios, but when you have an asset class, something like REITs, where a lot of the income over time comes from highly taxable income, then you will see that there's significantly less of them in our tax-sensitive portfolios than there would be in a standard portfolio. At certain points, they did even better than our standard portfolios because they had more exposure to growth, not because we were betting on growth doing well, but because that's a more tax-efficient way of capturing return in these portfolios. So yes, they are highly tax-sensitive. They are highly tax-optimized. We put a lot of effort into it. It does make our life a little more difficult, but these are interesting problems that we're happy to have. The one final thing is when it comes time to rebalance, and one of the rebalances in 2020 was specifically a tax-sensitive model rebalance when we were trading a portfolio only a few months after our previous rebalance, so that we are doing very targeted trades to make sure that we were minimizing any tax impacts and maximizing our sort of risk management of the portfolios that we could do with these relatively small trades.
Awesome. Thank you, Robert. Another question we have from Ethan. He's wondering what our view on inflation looks like right now and how we think inflation is going to inform our decisions through the end of 21 and beyond.
Good question. Our view on inflation is consistent with Jerome Powell's position. High inflation is likely transitory because it's driven by temporary factors like supply bottlenecks and stimulus checks. Also, bond markets thankfully indicate that inflation is expected to moderate. However, we don't make bets about future inflation, so our portfolios are well positioned for the possibility that inflation persists. We continue to invest in gold and inflation-protected bonds, which are nice hedges against the possibility of inflation. Also, our portfolios are optimized over many investment scenarios, including ones where inflation is high. Moreover, we regularly adjust our capital market expectations, which accounts for changes in bond markets. So whenever inflation affects bond markets, our optimized portfolios adjust dynamically in order to be well positioned for the new market environment.
And
Oh, go ahead, Joy.
yeah, and I can add to John's point. If we look at 5-year break-even, 10-year break-even in the market, so they reflect the people's expectation of future inflation in 5-year and 10-year respectively. And at this moment, 10-year break-even is below 5-year break-even, which supports what John said about the markets believe that the inflation is transitory. And also in terms of our portfolio construction, when people thinking about inflation, they want to go for assets that tend to do well in inflation, like high yield, for example, high yield, emerging debt, and also gold, REITs. And when it comes to equities, it's more tend to be small caps and value to some extent. So, and our portfolios have those exposure, and we balance across different exposures along with other risk factors. Again, as we've mentioned, we optimize over different scenarios. So the one scenario of rising interest rate is well handled in our process.
So yeah, we've been kind of tired of talking about inflation almost so much. Everybody's bringing it up in all the media, on television, everywhere. We heard about lumber prices and used cars, and I didn't really believe any of it until I came into work and went to get a sandwich. And my favorite sandwich was 50% more expensive than it had been, and they told me about how expensive the bags were. And so it's questionable about how transitory some of these things can be when some prices are sticky. But we do know that eventually, think about the sandwiches. A lot of places close. There's not, unfortunately, my second favorite sandwich place isn't there anymore. maybe my third favorite sandwich place isn't there anymore. So there's not a lot of competition, but in another 6 months or a year, the competition will be back, and there will be cheaper sandwiches. So so it's not all about sandwiches, but it is, and certainly we don't invest in sandwiches. But I do appreciate what John said about you know, optimizing in 27 different asset classes, optimized over thousands of different scenarios, and some of those scenarios inflation is higher than others, and so we want to make sure that we are not exposed too much to any one risk in our portfolios. And the final point on inflation is that I made earlier is if it's inflation, it matters where it's coming from. If it's coming from a good economic environment, then probably a balanced, globally diversified portfolio is going to be okay. Thanks.
Awesome. Great sandwich analogy, Robert. And it looks like we have another question from Zara asking which sectors we think are expected to perform best looking at the rest of the year.
Does anyone want that one? I think this is the hardest kind of question for us, because this is not how we think. We think about trying to understand all of the global risk and return trade-offs, trying to cast a very wide net about potential sources of return, you know, returns from risk factors, making sure all the asset classes we invest in have a risk premia that's explainable and likely to be persistent in them. And that makes it, we try to stay out of the game of picking any little thing that we could be wrong about. And so that's not just stocks and periodic tables of asset class returns, but that goes for sectors as well. And so clearly there are some sectors that are more defensive and others that are more aggressive. But we want to try to capture all of them rather than focusing on just one where we might be wrong.
Great. Well, it looks like that is all for our questions today. If you think of a question that you forgot to ask during the webinar, we encourage you to reach out to myself or any of the sales team members or anyone from the investment committee. We encourage you to let us know if you need anything, and thank you all for attending today.
Thank you.
Thanks.